Budget 2022 has been a huge landmark for the Indian crypto industry, with the finance ministry taxing all digital assets, including NFTs, at 30%. At first glance, it looks like a step in the right direction. But at this point, there are more questions than answers. And we've got Anoush Bhasin, a chartered accountant and a digital asset advisor, to help us navigate through some of this ambiguity. Anoush, welcome to Moneycontrol.
Thank you so much, Rahul. It's a pleasure to be here.
Great. Anoush, so lots of questions coming in. There's a fair bit to unpack here. But first of all, how do you view this ruling?
I think it's a step in the right direction. We've been hearing so many rumors about a ban since 2019. Finally, to see the government come and even designate this asset class as virtual digital assets rather than private cryptocurrencies or any other narrative that we've been hearing in the past. I feel that the government has taken a right step. They've done their research. And even though there are a few points that we feel a little undone about, I think this is definitely a good step. And, we build on top of this.
So, let's try and simplify some of this, preferably with examples when possible. So you cannot offset your loss in one asset class against your gains in another asset class. So does that mean if I've made a loss in the stock market, I can't offset that against the gains in crypto, or does that work for the same asset class as well?
That's exactly correct. So what they've done is they have created virtual digital assets as a completely separate asset class. It is not being compared to any securities, stocks, equities, debt, anything of that sort. And nor is it being compared to any other business. For example, if I'm a garments trader, garments are my stock and trade, which I buy and sell on an everyday basis. They're saying virtual digital assets are completely separate. Only a profit or loss within that asset class can be set off against each other. If you have a loss in that asset class, you cannot set it off against any income. So just taking my example forward, if my garment business has been profitable during the year, and if I incurred a loss in digital assets, I cannot set off the two. I will have to be paying taxes on the profitable business separately.
But if I have made some money in Ethereum and I've lost some money in Bitcoin, I can set that off, right?
Yes, within the asset class, within virtual digital assets, you should be able to set off those a profit and a loss. And if the government does not allow setting off, a profit in Ethereum against a loss in Bitcoin, that typically works against the principles of natural justice. The intent of the law is to not allow set off against a different asset class, but in the same asset class, the set off should be permitted.
Okay, great. So I have another question now. How does one define transfer of virtual assets, right? So if I move my funds from a centralized exchange like WazirX or CoinDCX into a self-hosted wallet, it could be my hardware wallet like a Trezor or a Ledger, or even my MetaMask wallet, my Web3 wallet. Is that a taxable event as well?
Yeah, so the government has actually played it pretty smart by saying that income on the transfer of any virtual digital asset is taxable. They have not said that income on the sale of a virtual digital asset is transferable, because they understand this space is so fluid. There are so many different movements amongst these asset classes. You can't typically just use a word such as sale. So while they have not defined the term transfer, so it's up to your and my speculation to try and understand which transfers would be included and which wouldn't. But if we look at the tax law, there is a particular section which actually defines transfer. Now, this is for capital gains and capital assets, an existing asset class. But there, the term transfer means three things. Number one, sale. Number two, exchange. And number three, relinquishment. So if I were to sell my assets, I would have to be paying, it would be considered a taxable event. If I were to exchange my assets, which typically also happens in the crypto market, that, I have Bitcoin, I want to switch it for Ethereum or any other asset class, that again will be considered a taxable event. And number three, relinquishment. If I give away my asset, I had a profit and I have given it away to somebody, that also could be considered as a taxable event. We would still need more clarity from the government that, if I were to move my assets from one wallet that I own to another wallet that I own, that typically is neither. It's not a sale, it's not an exchange, it's not a relinquishment. I still own the asset. Typically, that should be excluded from this term, transfer, but it's something that we have to make some representations and get some more clarity from the government.
No, just go back a bit. You said that if I swap my INR for BTC, that's a taxable event as well?
No, so if you're actually swapping your INR for BTC, that is an acquisition event. Transfer would be an event where you're either selling, which means that you swap your BTC for INR, or you swap your BTC for ETH, or potentially you swap your BTC for certain goods and services. All those three could be classified as transfers, which are taxable events.
Okay, so if I transfer money to my centralized exchange and swap it, let's say, for another token, and then I move that token to my MetaMask wallet, that becomes a taxable event.
Well, really, what you've done is you've purchased an asset and you've transferred that asset that you own now from one wallet to another wallet you own, right? You haven't really realized any profits. Even if there has been certain appreciation in that asset since the time you acquired it, you still own that asset. So until there is a subsequent sale, exchange, I wouldn't think that that asset or the income on that asset has been realized. So the taxable event has not occurred. The taxable event will occur when then you subsequently exchange that asset for another asset, or you sell that asset for INR, or you sell it for any other value.
Interesting. Okay, so moving on to TDS, and there's a lot of questions around TDS. So the ministry is levying a 1% TDS on trades. So let's dive in a bit deeper. Are the exchanges collecting this? Let's say I trade my Ethereum, which is sitting in my CoinDCX wallet, and I sell it for INR, and I want to move that INR to my bank account. Is that when the centralized exchange is going to collect 1% TDS or deduct 1% TDS in this case?
So the interesting thing is that, number one, the tax law has not mentioned anything about money moving into banks or money moving into INR. The only term they've used is transfer. So potentially, even if I am swapping my Bitcoin to Ethereum, that is also a transfer on which TDS could potentially be applicable, as long as we cross the monetary threshold that has been described. In terms of how TDS would be deducted and collected, that's something, the mechanism of which still needs to be defined by the government. Potentially, that is the reason why there is a timeline of 1st of July, 2022. Now, your question about CoinDCX deducting this and depositing it with the government, that's typically how it should work, because these centralized marketplaces are the only platforms who have PAN details and all of the information about all of the traders or the users on the platform. If me or you as a user have to individually on each trade get the details of the other party against whom we are trading and then deposit TDS on their behalf, I mean, number one, it's going to be a huge utilization of our times. Number two, we'll have to, it's also a security concern, right? How many people's data will we take in terms of their PAN numbers, their personal information, depositing tax? So this process definitely needs to be streamlined. I think the easiest way to do it would be to pass the onus of TDS compliance and depositing with the centralized marketplaces rather than individual traders.
That would increase their compliance cost, correct?
Yes, I think this is basically a cost of being regulated and the cost of becoming, a gatekeeper or a friend of the government. And it's certainly more practical than implementing this on a very democratized basis on each individual buyer or seller.
So how does the government capture TDS if you transact on an international exchange like Binance?
So it's that's again something that the government has not addressed. And typically what should happen is that when we are interacting on an international exchange like Binance, we should know who is the other party to this trade, right? If we are buying, somebody is selling the equivalent amount. And then based on that, we need to have their PAN details to deposit TDS. So while this could still potentially be possible when both interacting parties are Indians, the Indian exchange would have all of the information. But when these trades happen on international exchanges, number one, getting data off the other side or the other party is going to be difficult. Number two, getting these international exchanges to comply with these laws could also be a question because they are not physically situated in India. So again, something that the government is going to have to come out with more clarity about, and potentially, the government in the broader regulatory framework, when they come out, could restrict Indians only interacting with Indian exchanges.
So you're not, so it's a FEMA violation if I transfer funds from, let's say, my centralized exchange here to, let's say, a Binance wallet.
Well, it's not a FEMA violation because currently the Foreign Exchange Management Act talks about foreign currency and securities. And under neither of those two terms does cryptocurrencies or virtual digital assets currently fall. There was actually a right to information that was filed in 2018 with the RBI, which requested clarity on the same subject, that is FEMA currently applicable to virtual currencies or digital assets? And at that time, the response was no. So for FEMA to typically apply to this space, virtual digital assets will have to sort of be covered by or defined within one of these definitions. But let's not forget that the intent of the law or the regulator is that money or value should not leave the country. So for me, if we are moving assets abroad, even though it's not typically defined under the FEMA, we are still doing something which is against the intent of the regulator.
Okay. And moving on to decentralized exchanges, how does one track gains in decentralized exchanges and DeFi platforms where you can participate in yield farming?
To answer your first question, in terms of tracking these returns, I think there are a few tools are being developed on a global basis, which monitor your on-chain wallets, your MetaMasks and the sorts, and which will be able to tell you that, okay, this was the amount of yield, or these are the amount of tokens you earned by staking, by yield farming, or any similar activity. So you could potentially use one of those tools. In terms of taxing them, the government, again, has just played it very, very simple and straightforward. They said any transfer is taxable. So if I am suppose depositing 100 units of a particular token for yield farming, and I get 2 more tokens in return as the yield, so then those 2 tokens have essentially been transferred to me, and that transfer in itself becomes a taxable event.
Okay. And, we haven't really touched upon the issue of gas fees, especially on layer 1 of Ethereum. So let's say I buy Ethereum worth 1 lakh rupees on a centralized exchange and move it to my MetaMask wallet for the purpose of trading, swapping, yield farming, whatever, right? Now, sure. I have, gone into one of those DeFi platforms and staked 1 lakh rupees worth of Ether. I'm paying a gas fee. So I'm not exactly staking 1 lakh of rupees. Perhaps I'm staking 90,000 worth of Ether, and 10,000 is the gas fee that I've paid. Now, let's say that amount appreciates to 1,20,000 worth of Ether, and I want to, take my profits out. So can I show the 10,000 rupees gas fee paid as a loss, or as an expense rather, against my profits that I've made?
Yeah, Rahul, that's a brilliant question. And it's probably one of the most sensitive topics to everybody in the crypto space, because the gas fee is so high, especially on Ethereum. It typically should be allowed as an expense, because it is an incidental expense to earning the income or to engaging in this activity. However, as the wordings have been introduced, day before yesterday during the budget session, they have said that no other expenditure or deduction will be allowed other than the mere cost of acquisition. So if we read it, prima facie, it means that incidental expenses would not be allowed. But again, this is one place where we would have to make a representation and request the government to at least allow whatever are directly attributable expenses. If I need to earn 10 rupees on top of 100 rupee investment, and there is a 2 or 3 rupee expense involved, which is very, very necessary to earn that return, then it typically should be allowed as a deduction. And as is the case in all other parts of income tax, that if I'm spending a lakh of rupees on a business, then that lakh of rupees is counted as a deduction when determining my tax liability.
Right. And on the same topic, right? So my 1 lakh rupees, let's say, has become 1,20,000, and I choose to withdraw just 1 lakh rupees back into my centralized exchange. Perhaps I've swapped that 20,000 rupee profit into another token on, let's say, Pancake Swap, which is a DEX on Binance Smart Chain, or any other token, Uniswap. Let's
sure
with that, yeah. So I've got my profits in another token. I have invested 1 lakh of rupees, and I've taken out 1 lakh of rupees worth of Ether and moved it back to my centralized exchange. So at least on my centralized exchange, my profit, and there's no profit, there's no loss. So am I not taxable there, or do I have to declare that 20,000 rupees worth of Uniswap tokens that I've got? Do I need to declare that as well?
Anytime you have created a profit, there are 2 situations. it's an unrealized gain, which means that the value has gone up, but you have not transacted on it. At that case, it is not taxable. As soon as you realize it, whether it's in the form of INR, it's in the form of bringing it back to your central exchange, or it's in the form of switching it for another token, as soon as you book that profit, you are going to be liable for taxes.
And what about airdrops? So how are they taxed?
And what the government has done here is they have come out with a clarification. Now, this is not a new law. Gifts were always taxable, but because the government realizes that airdrops are so common, they simply included the word virtual digital assets in the gift tax section. And simply the law is that if you have received gifts greater than 50,000 rupees of value INR in a year, that gift will be taxable, except if you have received it from a direct relative, maybe your father or mother, your children, your siblings, etc. Only those gifts are exempt. Other than that, as soon as you get an airdrop, the fair market value of that airdrop on that day will become income that you will be subject to tax.
Or let's say I receive an airdrop on April the 10th, because the next financial year. I will be taxed based on the value of the airdrop on April 10th. Am I right?
Yeah, the activity of bringing it to the centralized exchange is not the trigger. The activity of realizing or accruing that income is the trigger. So as soon as you receive that airdrop and it has certain value, that is the activity or the event that makes it taxable.
Because I'm getting a lot of messages from people in different groups where they're saying that, you know, they only have to pay tax when they transfer that money to their bank account, and only then it's a taxable event. And there's been some confusion regarding that. So thank you for clarifying that.
This assumption that only income that's brought to your bank is taxable is incorrect to the extent that it's going to make a huge portion of the economy untaxed if people think that it's not coming back to your bank. And the regulator is also very quickly going to be able to figure out, probably they have already, which is why they have used the word transfer and not sale to your bank account or sale to INR. And that was never the intent of the regulator in any case. If you simply read the tax law, it says any income is taxable other than a few incomes which are specifically exempt. It's possible that I provide certain services and I receive gold bars as you know, a mode of payments. It doesn't mean that those gold bars are not taxable, right? The government always knew that there could exist a barter system in the country, and that barter system also needs to be brought under the ambit of taxation. So just because crypto is slightly different, you know, you can move your funds around, potentially think that this is anonymous, nobody's going to be able to track it, which is why it's not taxable. It's a bit of an aggressive position that you're not paying taxes until you're not going to be tracked, but the government is definitely going to consider any income you realize as taxable.
So what if April 10th, I received airdrops, let's say worth 1 lakh rupees. Yeah. I choose to pay a 30%. I don't choose to pay, I have to pay a 30% tax. Yeah. I pay 30,000 rupees, but I choose not to convert that airdrop into, you know, a stable coin or INR. And I choose to let it ride. And that 1 lakh rupees becomes 2 lakh rupees over a period of time. Now, when I choose to cash out at that point, am I again paying a tax? Because I've already paid tax on the same number of tokens. I've already paid a 30% tax on it. So am I liable to pay tax again?
Yes. So what will happen is, if you on April 10th, when you receive that initial 1 lakh, you will be paying a 30% tax, which leaves you with 70,000 rupees worth of an asset. You hold that and it goes up to a 2 lakh rupee value. Now the 70,000 rupees that is left with you, or sorry, the 1 lakh that is that you initially already disclosed and paid taxes on, becomes your cost of acquisition for that asset. So now when you are selling at 2 lakhs, 1 lakh is already your cost of acquisition, and only the balance 1 lakh that you have now realized in profit will need to be taxed again at 30%.
Okay, isn't that double taxation?
No, they are only taxing you on incremental gains. So they taxed you once on your initial lakh, then they will tax you again on the next lakh. They are not taxing you twice on the initial lakh.
Right. Okay. That's yeah. So those who are thinking that your airdrops are unrealized gains and you don't have to pay tax on it are in for a rude shock, correct?
Unfortunately, yes. I think that's the government's intent is to try and bring as many different incomes in the ambit of taxation. And it's actually pretty neat that they have gone to the extent of defining gift taxation for crypto, because they would have realized that there are so many airdrops that are happening in the ecosystem.
Anoush, now a lot of projects in this crypto space, in the digital asset space, tend to pay their employees in crypto or in tokens. Now, how does one navigate through that? Someone who's earning tokens as part of their remuneration, they're just confused as to whether they're supposed to pay tax on it or whether they're forced to convert that to INR and then pay tax. How does one go about that?
Sure. So typically when anybody is involved with a decentralized project where there is no company, there's no corporate entity, the mode of payments have been tokens or the native tokens of that particular project. The downside for all of the people who have been receiving payments in tokens now is that they're going to have to pay a flat 30% tax on their income, rather than being allowed to deduct certain expenditure from that income and then paying tax only on the balance. So for example, if my monthly fee was 100 rupees, and if I were to get it in tokens, then I would be paying a flat 30 rupees tax on it. However, if I was to get that 100 rupees in fiat or in legal tender, I would be able to deduct most of my incidental business expense costs, my rent, my electricity, staff costs, depreciation, electronic costs, and a lot of other things, and potentially bring that 100 rupees down to say 30 or 40, and then only pay 30% of that, which is probably 9 or 10 rupees, right? So
yes.
Yeah. So the what's happened is that anybody who's receiving funds in payments in tokens, their tax liability has gone significantly up. This is potentially a move by the regulator to deter or to discourage people from taking payments in tokens and encourage payments in INR, which has also ties in with the broader scheme of the position of the government, right? That this is an asset class, you buy and sell it, but please don't consider this as a currency or start accepting or processing payments in it.
Interesting. But a lot of people in this space are also invested in a lot of DeFi projects from the IDO stage, which is initial DEX offering. The closest analogy would be an IPO,
Sure.
the traditional finance world. And there is a vesting period for those tokens. So I may have invested a small amount or whatever that amount is during the IDO. It's like a pre-sale, in the pre-sale round rather. And there's a vesting period of 2 years. And I get my tokens after 2 years. Now, that could be a significant amount. It could go down to zero if the project fails, but it could also be a significant amount, often running into 7 or 8 figures. In a scenario like that, does the same rule apply that when you get those tokens in your wallet, that's when you're supposed to pay your 30% tax on it? And if you don't have the liquid INR, you have no choice but to liquidate some of those tokens to pay your taxes.
Yeah, so typically the event of your income being taxable would be the event where you actually acquire those tokens, right? If I have invested in a particular token and I'm going to get it after 3 years, but I have to remain invested, any potential gain on that token is unrealized. It's only when I get that token and I decide to realize the gain by selling that token or exchanging it for something else, that is the time I have to pay tax. However, if I just choose to hold on to it and it keeps appreciating in value, really all of that gain is unrealized and I don't have to pay taxes until the day I decide to realize that gain. I'd like to just draw a differentiation from an airdrop, because an airdrop is where I receive free tokens. I have not paid anything for it, but in the event of an IDO, I'm actually paying in a particular currency or in a particular token to acquire that investment. So in case of me having made an investment, the taxable event is only when I realize the profit or I sell those tokens. However, in case of an airdrop or a gift, the taxable event is as soon as I acquire those tokens.
That is a very important differentiation here. And that was my next question, in fact, and thank you for clarifying that. To sum it up, I want to ask you what your opinion is on how is this going to affect projects that are trying to build in this space and raise funds in India? Do you think there's going to be a huge brain drain and people want to build elsewhere, or do you now think that people will want to build within India?
I think the regulatory risk component when investors decide to invest in an Indian project has been fairly high because of uncertainty around what position the government is going to take. That regulatory risk might decrease a little bit now that there is clarity around tax laws, but I think it still remains to a large extent that projects are more comfortable incorporating overseas, incorporating in crypto-friendly jurisdictions where at least a broad regulatory framework exists, and then they start engaging with with employees, with consultants, with engineers all over the world, including a lot of folks from India. That is not going to change until the government comes out with a broader framework, which really encourages crypto investments, raising money in crypto, spending money in crypto. And as long as we're not at that stage, I think it's going to be a little bit difficult for projects to really set up and domicile and headquarter themselves in India. However, we will see a lot of participation by freelancers working in decentralized or global projects. We will also see a lot of Indian projects setting up overseas, but still keeping their roots towards Indian employees, Indian communities, and the like. So I think it's not that big of a loss in terms of brain drain, because this is a global and decentralized system. But at the same time, I do feel if the government was able to come out with a broader framework which supports crypto investments, we could be seeing a lot of foreign money flow into our country.
Great. Thank you so much, Anoush. This has been an absolute masterclass, and hopefully we've answered a lot of questions. Thank you for joining us, and hope to see you soon.
Thank you, Rahul. Pleasure to be here.